Every Saturday morning, two golfers tee it up. One of them is pulling driver on every hole, attacking every pin, going for every par 5 in 2. The other one is hitting the center of the fairway and two-putting for bogey. Guess which one retires a millionaire? The answer is going to change how you think about your money, because the exact same mistake that blows up your scorecard is the one that blows up your portfolio. You know this golfer. You might be this golfer. The par chaser is the guy who stands on the tee of a tight par 4 with water down the left side, and instead of hitting a safe iron to the middle of the fairway, he pulls driver, because driver gives him a chance at birdie. It also gives him a chance at double bogey, but he's not thinking about that. He's only thinking about the upside. On approach shots, same thing. The pin is tucked behind a bunker, short-sided, on a downhill slope. And instead of playing to the fat part of the green and taking his two-putt, he fires right at it. Sometimes it works, most of the time it doesn't. And when it doesn't, he's in the sand, chipping out sideways, making 6 on a hole where 5 was sitting right there waiting for him. This is where it maps perfectly to money. The par chaser investor is the person who hears about the hot stock, the trending crypto, the company that's supposedly about to explode, and goes all in. They skip the boring stuff. Index funds? Too slow. A diversified portfolio? Too boring. They want the stock that doubles in 6 months. The investing equivalent of sticking it to 3 feet from 70 yards out. And just like on the golf course, it feels exciting. It feels like the smart, aggressive play. But the math tells a very different story. Now let's talk about the other golfer, the bogey golfer. This guy doesn't look impressive on any single hole. He hits the center of the fairway, not long but in play. He aims for the middle of the green, not close to the pin but on the putting surface. He two-putts, he writes down a 5 on a par 4 and moves to the next hole. Nobody's filming this guy. He's not making the highlight reel. But here's what's actually happening beneath the surface. He finishes every round. He never posts a 7 on a par 4. He never walks off a hole shaking his head because one bad decision cascaded into 3 more. And over the course of a full season, 40, 50 rounds, his handicap drops. Slowly, quietly, consistently. That is exactly how wealth is actually built. The bogey investor doesn't pick individual stocks. Instead, money goes into a broad index fund. The S&P 500, a total market fund, something that tracks the entire course instead of betting on one hole, automated. Every paycheck, money goes in, no checking it daily, no panicking when the market drops 10% in a week. Just keep playing the round. And I know what you're thinking. If it's this simple, why doesn't everyone just do this? Because simple is not the same thing as easy. Laying up when everyone else is going for the green is psychologically brutal. Staying patient when the strategy feels boring takes real discipline. The bogey golfer's strategy is simple to understand. It is hard to stick with. And that gap between knowing and doing is where most people lose their money. The S&P 500 has averaged roughly 10% annual returns before inflation over the long term. Whether you can invest $200 a month or $500 a month, the principle is identical. The amount matters less than the automation and the consistency. Someone who starts at 25, automates it, and never touches it is looking at a massive number by 55. Not because they were brilliant, because they played bogey golf with their money for 30 years. They aimed for the middle of the green every single time. There's something else most par chasers never think about. It's not just the bad shots that cost them, it's the hidden strokes. In golf, there's a concept every competitive player understands. Penalty strokes. You hit it in the water, that's a penalty stroke. You go out of bounds, that's a penalty stroke. They don't care how pretty your swing looked. They get added to your card whether you like it or not. And here's the thing about penalty strokes. Most golfers wildly underestimate how many they're actually taking. They remember the one great drive but forget the 2 penalty drops. Investing has its own version of penalty strokes. They're called fees. Except unlike penalty strokes on the course, these don't come from bad swings. They get added to your card on every single hole, whether you play well or not. Every fund you invest in charges what's called an expense ratio. It's a percentage that gets quietly taken out of your returns every single year. And just like penalty strokes, most people have no idea how much they're actually paying. Here's the part that should bother you. An actively managed mutual fund, the kind where some portfolio manager is trying to beat the market, picking stocks, going for pars and birdies, typically charges somewhere around 0.5 to 1% per year. That might sound tiny, but a basic S&P 500 index fund, the Bogey Golfers Fund, charges as low as 0.03%. That's the difference between dropping one penalty stroke every round and dropping one penalty stroke every 30 rounds. So what does that actually cost you over a career? If you invest $500 a month for 30 years and earn an average return of 10%, but you're paying a 1% fee, you'll end up with roughly $170,000 less than if you'd been paying 0.03%. $170,000. Gone. Not because you made bad investments, not because the market crashed, because you were quietly paying penalty strokes that never showed up on your statement in bold print. The Bogey Investor checks the expense ratio before buying any fund. It takes 30 seconds. And over a lifetime, that 30 seconds is worth a six-figure difference. The par chaser doesn't even know what an expense ratio is. They're too busy looking for the next hot pick. Now here's where this gets ugly, because the par chaser doesn't just underperform the bogey golfer. They blow up. And when they blow up, the damage is brutal. Think about what happens when that aggressive tee shot goes into the water. It's not just a one-stroke penalty. You're re-teeing or dropping. You're hitting 3 from the tee or punching out from a terrible lie. One bad decision turned a potential par into a triple bogey. One hole just erased the birdie you made 3 holes ago. And then some. That is how portfolios get destroyed. When you concentrate your money into one stock or one sector and it drops 40 or 50%, you don't just lose this year's gains, you lose years of progress. And here's the number that should scare you. A 50% loss requires a 100% gain just to get back to where you started. If your portfolio drops from 10,000 to 5,000, it needs to double, not recover 50%, double, just to break even. That math is unforgiving and most people don't understand it until it's too late. The bogey investor never faces that math. Because they're diversified across hundreds of companies, no single blow-up hole can wreck their round. One stock in the index crashes, they've spread their bets across the entire course instead of putting everything on one hole. The damage barely registers. In golf and in investing, avoiding catastrophic losses is more valuable than chasing big wins. The math is not symmetric. Blow-up holes and blow-up investments do damage that takes years to undo, if they can be undone at all. Now, if you're in your 20s watching this, I know exactly what you're thinking. You're thinking, sure, but I'm young, I have time to recover, I can afford to take big swings right now and play it safe later. And on the surface, that logic sounds right. In golf terms, it's like saying, I'm only on the front 9. I've got the whole back 9 to make up for any bad holes. But here's what that logic misses. Your 20s aren't just the front 9, they're the most valuable front 9 you'll ever play. Because every dollar you invest at 25 has 30 or 40 years to compound. A dollar invested at 25 does roughly 7 times more work than a dollar invested at 45. That's not a guess. That's just how compound growth works over decades. So when you take a massive swing in your 20s and lose 50% of your portfolio chasing some speculative stock, you're not just losing today's money, you're losing the most powerful compounding years those dollars will ever have. You're throwing away strokes on the front 9, the exact holes where bogey golf does its most important work. The biggest advantage young investors have isn't the ability to recover from losses, it's time in the market. And every year you spend recovering from a blow-up is a year your money could have been compounding. Youth is an argument for consistency, not for gambling. If you don't believe me, look at what happened in March of 2020. COVID hit, the world shut down, and the stock market fell off a cliff. The S&P 500 dropped 34% in about 5 weeks. Your portfolio, my portfolio, everybody's portfolio got crushed. Social media was full of people panic selling everything, convinced the economy was done, convinced this time was different. The par chasers, concentrated in individual stocks, leveraged up, chasing the hot picks. They got destroyed. Some sold at the bottom and locked in those losses permanently. They walked off the course mid-round. But the bogey investors, the ones who had their money in diversified index funds and didn't touch it, they recovered to new all-time highs within about 5 months. 5 months. and then the market kept climbing. Someone who had 100,000 in an S&P index fund in January 2020 watched it drop below 70,000 in March, did absolutely nothing, and was back above 100,000 by August. By the end of 2021, they were sitting on well over 150,000. Not because they were geniuses, because they played bogey golf through the worst conditions any of us have seen in our lifetimes. And it's not just 2020. The same thing happened in 2008 during the financial crisis. Markets dropped over 50%. Bogey investors who held on recovered everything within about 4 years and kept compounding for the next decade. The pattern never changes. The course always rewards the golfer who stays on it. Consistency compounds. Volatility destroys. I want to be honest with you about something because this is the part nobody talks about. The hardest part of bogey investing isn't the strategy. It's the people around you. It's your coworker telling you they just tripled their money on some stock you've never heard of. It's scrolling social media and seeing 23-year-olds posting screenshots of massive gains. It's your buddy in the group chat saying you're leaving money on the table by sitting in index funds. And in that moment, your boring, consistent, center of the fairway strategy feels painfully slow. That's the equivalent of standing on the tee, watching your playing partner hit driver over the water and stick it on the green. And then you pull out your 6-iron and aim for the middle of the fairway. It doesn't feel good, but here's what you never see. Nobody posts their losses. You never hear about the stock that dropped 80% that they're still holding. You never hear about the guy who went all in on crypto and quietly sold at the bottom. Social media is a highlight reel of par chasers on their best holes. It is not the full scorecard. You don't compare your game to someone else's best hole. You compare full rounds. You compare full seasons, and over full seasons, bogey golf wins. Number 1, play the center of the fairway with your money. Open a brokerage account this week if you don't have one, and set up an automatic monthly contribution to a total market index fund. Whatever you can afford, 100, 200, 500, it doesn't matter. That is your center of the fairway shot. Automate it and stop thinking about it. Number 2, before you buy any individual stock, ask yourself one question. If this drops 50% tomorrow, can my portfolio recover? If the answer is no, you are going for a pin you cannot reach. Lay up. Protect your downside. The birdies are not worth the disasters. Number 3, delete your brokerage app from your home screen. Seriously, check your portfolio once a month maximum. You don't check your handicap index after every hole. So stop doing it with your money. Zoom out. The trend over years is the only scorecard that matters. Before you leave, drop a comment and tell me, are you a bogey investor or a par chaser? Be honest. I want to know. And if this way of thinking about money clicked for you, the next video is going to take it even further. We're breaking down the entire stock market through 18 holes of golf. And it's going to change how you see where your money actually goes when you invest it. Hit subscribe so you don't miss that one.